Hi, everyone, and welcome to this important discussion on digital credit providers and regulation. I'm honored to be here. My name is Jerry Wagasha. I'm a partner at Cliff Decker Hoffmeyer in Kenya. I also run the podcast at Jerry Talks Law, which is a legal podcast. And I am honored to have with me David Cracknell, Kevin Mutiso, and Ivan Boa. And I'll just let them introduce themselves. So Kevin first.
Good morning, everyone. Thank you for attending this session. My name is Kevin Mutiso. I am the chairman of the Digital Lenders Association of Kenya, an association of over 20 digital lenders. We lend about 4% currently of all disbursements in the market, with the rest being done by the banks. I am also the CEO of Alternative Circle, a digital-first solutions provider for digital financial services. Asante.
Your turn, David.
Okay, my name is David Cracknell. I'm the managing director of First Principles Consulting, a consulting company in Kenya concentrating on financial services. I've been in Kenya for the last 20 years, so this is very familiar territory.
Ivan?
Hi, good morning, everyone. My name is Ivan Mboa. I am the Managing Director of Tala here in Kenya and also Director of the Digital Lenders Association of Kenya. Tala, as some of you may know, is a mobile technology and data science company focused on access to credit. We began in Kenya about 7 years ago and have since sort of expanded to serve well over 3 million Kenyans and expanded our work out into Tanzania, the Philippines, Mexico, and most recently India. Pleasure to join you all this morning. Thank you.
Thanks very much. So we're talking about digital regulation. I'm a corporate lawyer, and for me, regulation means adhering to bureaucracy, filling in forms, applications, vetting, all of the good things that comes with asking for an application or a regulation to be approved. You guys as digital lenders or digital providers or people in the digital space, your proposition is that digital regulation should be discouraged. We will be debating this issue over the course of the next 2 hours. I want us to have a fruitful discussion, and therefore I want us all to have our own propositions and set out what we think should be the position in this country. So let's start with David first.
Okay, I actually think that some form of regulation, whether it's licensing or registration, some form of regulation is going to happen. It's not a question of whether we want it, whether we like it. It's a question of the maturity of the industry, and it's a question of financial conduct. So just to make a few points on financial conduct, we've seen that there's been a rapid increase in the number of people who are negatively listed. And this is a consequence in part of the methodology of the digital lenders. Because they're digital, they don't have the people involved in the lending process. It's the reason that they're very efficient, but they need the ability to effectively blacklist people as part of their loan recovery mechanisms. It's the threat of blacklisting that gets the money back in part. But we've also seen other things happening. We've seen the distinction between responsible digital lending, if you like, and irresponsible digital lending. Regulation is less about controlling the activities of responsible lenders. It's about controlling the activities of irresponsible lenders.
I think David's frozen. So while his network gets back to us, Kevin, why don't you go ahead? Tell us your proposition on this regulation question.
Did you say Kevin or Ivan?
Kevin, I said Kevin, but Evan is welcome to go first as well.
Oh.
Okay, so let's hear from Ivan first.
All right, can everyone hear me? And Jerry, can you hear me?
Yes, I can. Yes, I can.
Okay, great. So I guess my position is both Tyler and DLAC believe that the digital lending industry, which we represent, has really accelerated financial inclusion and closed the gap in access to capital for millions of individuals and small businesses in Kenya. And of course, numerous studies have really underscored the positive benefits of our sector and our services in both individual households and the broader economy. However, as responsible leaders of the industry, while we're proud of the gains and benefits to society that we've delivered, we also sort of join the government and consumer stakeholders in sort of calling for sort of regulatory framework. So just to echo what David said, not only do we think it's inevitable, but we're also in favor of it, right? To sort of govern digital finance so that consumers may enjoy the benefits of financial access without the risks. And the reason why we say that is that even though the members of the Digital Lenders Association in Kenya are the responsible actors that David was talking about, we also realize that this association does not represent all actors, and there are some bad actors, right? And as a result, no Kenyan should be subject to harmful practices or sort of bad actors in their quest for financial well-being. And I know some of the key pain points, of course, are really about transparency of the terms and pricing, right? And so we believe that, look, Kenyans should be able to easily understand the full cost of their loan before they borrow. If they fall behind in repayment, they should be treated respectfully. And they should know at all times that personal data is secure and will not be shared with others without their consent. And if they go ahead and repay the loan, I think that they should be properly rewarded with a positive credit record. So digital lenders are not just about negatively listing Kenyans. We also want to reward the Kenyans that are successfully repaying their loans, right? And they should know and be able to borrow confidently from any lender in this market, knowing that all digital lenders, providers are subject to the same standards and oversight. And so in conclusion, we really stand ready to work with government stakeholders to develop this sort of responsible regulation, which will hopefully rein in the rogue players, will promote fair industry standards, and really enhance the competitive landscape in order to increase customer choice. However, what we do want to caution against is sort of hasty and overly onerous and prescriptive regulation, which would actually go ahead and undermine financial inclusion efforts and significantly restrict critical access to credit. So I know we'll speak about that a little later on as we go along, but in short, we are in favor of regulation. We just want to make sure that it's done correctly in a way that will not sort of strangle or stifle the industry, and really ensure that Kenyans can continue to enjoy access to credit. Thank you, Jerry.
Great, thank you for that position. I think David is now he's back, so we can just finish off on your position, David, and then we can move on to Kevin. So David, take it away.
Okay, so sorry about Zuku. So what I was saying was we have had these bad behaviors. Now, if we want the industry to scale, we need to have mechanisms for controlling inappropriate behavior. But even more than that, the industry, in terms of financial technology, is moving to a stage where we need to be talking about financial conduct, and we need to be setting up appropriate mechanisms for ensuring financial conduct across a range of activities. And I see this regulation, if you like, of digital credit as part of that transition into the broader fintech regulation. Now, as part of that, I'm actually slightly less concerned about the licensing and regulations, although clearly there are things that need to be discussed, and I very much agree with Ivan in terms of his sentiment. But what we need to be able to do is enable people to report bad behavior and also have other mechanisms that can support this behavioral element. So, for example, in South Africa, under the National Credit Act, you've got various requirements that are set out for determining whether people properly understand the credit they're getting. These are the sorts of things that I think could be adapted and potentially adopted. And I think those sorts of things are potentially as important as whether we have a license or a registration.
Okay, thanks very much, David, for that insight. Kevin, your turn.
Thank you, Jared. Well, so as DLAC, I think we look at it from how do we create or continue solving for financial inclusion. I think our second objective, which is just as important, is sustainable business models. So we need to be able to not only disburse and collect, but make profit so that our business models are sustainable. And then, of course, for most of us, what is important is that we also have a minimum rule book, meaning that we have a minimum set of rules that every player in the market plays with, knowing that there are repercussions and consequences to basic those minimum rules. Around financial inclusion, why digital lending has been so critical is because, and yesterday I spoke about it, is if you think about the timeline of digital financial services in places like Kenya, M-Pesa, which started in 2007, now has 35 million customers, has provided a digital wallet where innovators like Ivan and I could create these products and deliver value to the customer. In 2013, the CRB regulations were released, and we now have had 3 versions, and we're about to have a 4th. And if you think about what the CRB has done, it has allowed us to do, willingness to repay and ability to repay checks. And of course, it has improved our ability to do proper and safe KYC. And if you think about it, it has also reduced our costs. So our costs as lenders have improved. Now, because of those 2 serious innovations, you had the proliferation of digital lending, and therefore various products came into the market and various ideas have been tested. I think now in 2020, the market has matured to the point where we have some bad actors. We have some actors who are not playing by the rules that we had initially thought should be the basic minimums. This is affecting customers. Because it's affecting customers, the regulation is necessary so that we have, as David has rightly said, a financial conduct rule book where us, the players, know what and what we cannot do. So when you hear issues of debt shaming, those are things that should be of the past. When I talk about sustainable business models, I think we have barely scratched the surface of the kinds of products we are offering in the market. David and I debate quite often, and one of the words he likes using is nano credit, and he's right. I think we focus too much on the fact that the lending is happening rather than on the types of products that are in the market. I don't think a Mama Mboga and a Boda Boda rider should be getting the same types of products, but at the moment they are. What will it look like in 10 years? They're very fundamental, they're fundamentally different business models, and because of that, they obviously have different needs. And what matters to us as lenders is we want to be able to offer those unique services and products. So again, regulation gives a level of stability to players like us who want to innovate and play around with different business models, knowing exactly what we need to do. And then, of course, there's, I've talked about conduct. Conduct is a big issue. This debt shaming is, something we keep getting lambasted about. And we as DLAC have come out very strongly against it because we know it's affecting the customer negatively, but it also affects us as the business in the long run. So those would be my quick takes. And so the way I'd frame my position on this regulation is, how are we making this regulation relevant for the products and services 10 years from now? Are we going to have businesses as big as Safaricom because of innovative and progressive regulation? Because we have the capital. Ivan's companies from the US, half my companies from Europe, and that's where we got capital from, right? We can get a lot more capital if we're thinking progressively about regulation. So that's where I'm standing.
Okay, none of you have answered I guess where we need to start from is none of you have answered the question of whether the CBK amendment bill, which is really the documentation or the piece of regulation that we're looking at, is fit for purpose at the moment, although all of you are talking about the fact that regulation should be encouraged. So let's talk about the specific piece of legislation. At the moment, it's quite wide. And it's quite broad, and it gives room for the CBK to be more prescriptive in the future. So we're not really certain about what impact it will have on digital lenders at the moment, right? But that is what we need to say. Do we approve of the piece of legislation? Are we against it? Or can it be improved before it's passed? So David, can we talk about that?
Okay. A legal framework is a legal framework, so it's going to set parameters. So it's the interpretation of that legal framework that matters. I can understand capital requirements. It's something which normally applies to deposit-taking institutions, but if the central bank is saying we don't want to have hundreds of digital lenders, we want to have digital lenders of a certain size in order to minimize some of their supervisory roles, etc. I could possibly see a reason for that. But if you take a look down some of the provisions, what we've got is okay, the central bank has the power to license digital credit providers. Okay, determine capital adequacy requirements, determine minimum liquidity requirements. I find this one slightly strange because as a lender, if you don't have liquidity, you don't lend. And it's not the borrower that has this constraint. Approve digital channels and business models through which digital credit business may be conducted. This is an entry point for the central bank to become more prescriptive by not so much the digital channels, but the business model element to say, okay, what's permissible in the business model, what's not permissible in the business model. But we're quite likely to begin to move towards that anyway, especially if the financial conduct issues are not properly addressed. Supervised digital credit providers. Supervision could be as much as being very prescriptive and supervising like a bank, or it could be light touch. We don't know what that means. Suspend or revoke a license. Okay, that's fine. Direct or require such changes as the bank may consider necessary. That's the catch-all phrase, which basically means that the central bank can change how they operationalize this license. So there's a lot of flexibility for the central bank to determine how it responds. So as I say, it's not what's on paper that's going to determine the future. It's actually the interpretation of this by the central bank that's going to determine the future. And to be quite honest, I don't think it's going to affect some of the bigger, more responsible digital credit lenders like Tala, because they will have the capital. They will be able to show a more responsible business model. They will be able to show how they fulfill levels of customer service, etc., etc., etc. But it will create constraints and barriers to entry for new entrants. And it does mean that the central bank, should they dislike something, they can come down and de-license somebody and effectively stop their operations.
Yeah, I do think that as a lawyer, and lawyers would argue that you need to confine or constrain the wording from the inception so that you're not allowing the flexibility that the CBK has, because obviously the wider the wording, the more likely it is to be able to be interpreted the way the CBK would like to have it interpreted. So from the get-go, it's important for us to look at the wording very carefully. But let's ask Kevin. Kevin, I want to know from you, you're fine with the legislation, but is legislation necessary? Because in some countries, for example, in Poland, all they have is a code of conduct, and not licensing, but just an oversight body to look at digital lending, and not really a licensing regime. Wouldn't that be preferable?
Okay, so I'll answer two questions. I'll answer the first question, which is what is the position of the actual CBK amendment bill as it is, and then I'll answer your question about is it really necessary. So from the current CBK amendment bill, there's certain challenges as lenders we see, and there's certain concerns we have. I think David has already mentioned one: prudential guidelines, minimum capital requirements, and liquidity ratios. When you look at it from us, the lender who are allocating the capital, we wonder, why do we need to have prudential guidelines when we're not taking any depositors' money, right? We take risk with our own money. Therefore, usually minimum capital and liquidity ratios are to protect a depositor's money. So the minimum capital is usually, if I'm taking deposits and I have a run on my institution, I should have this minimum capital to fund the depositors who may have lost their money. And then liquidity ratios are tools used for economic monetary policy, right? When you want to increase liquidity in a market, when you want to reduce liquidity in a market. And usually, again, those tools are usually depositors' money. So that the prudential guidelines from a private credit only lender actually just add to the compliance cost and the cost of capital, because what you're saying now is I have to take some capital, deposit it somewhere, and it doesn't earn me any return. And what that will in turn do, I will have to charge the opportunity cost on that capital to the consumer. So in effect, adding the cost of the loans. And everyone knows no one wants to pay more if they don't have to. I think the second issue we have, or the concern we have, is the business decisions. There's a section with the Act, the amendment bill, that speaks to approving our products, approving certain aspects of our products. We are innovators. We are trying to develop new business models. In my timeline yesterday, it took us almost 3 years for most of us to figure out what is even a profitable algorithm, a profitable data scoring method for the customers, because it was so new. And if we had to get approvals each time we wanted to test a model or an idea, and it takes 6 months, again, there's a cost of waiting. And then that's a business decision. We are startups. We want to fail quickly so that we figure out, okay, this doesn't work, and we want to move on, right? Again, on the business decision side, when we talk about precedents, there have been concerns in this market that it takes very long to get approval from various regulators. They have their own reasons. We empathize with them because, of course, they have a full plate. And that's why we think that, and we have added, one of the proposals we are making on Friday in the public participation is delegated authority for self-regulation, right? And this will be the first time this has happened in Kenya. A really good example is with the Kenya Bankers Association. Many of us may not know, but the clearinghouse where checks are cleared in Kenya is actually done by the Kenya Bankers Association, not the CBK, but have delegated authority from the CBK for the clearinghouse. Now, why does that matter to the banking ecosystem? It matters because if they control the speed and efficiency of the clearinghouse, it helps their businesses to be more efficient and helps them to manage their liquidity. So we are not asking to have, certain aspects that may be misaligned with the regulator and the customer. We're asking delegate that which makes our businesses more efficient and helps you, the regulator, do your job better and take a lot more off your plate. So that's how, some of the points, the key points that we have seen and concerns we have with the current bill. The final one is a transitionary period, right? If we are getting a new regulation and we have to comply, it'll take time for the business to comply. We don't have switches. We have processes that we have sort of embedded, business processes, and changing those processes takes time. It doesn't take a week. It'll take, you have to sort of get a team together. You have to look at the legal, you have to get the compliance, you have to check, does the product match all these things? And so that will take a bit of time. And so we want a transitional period where we can sort of, if the regulation is passed and hopefully it's progressive, and then we get we have to abide by them. We get about a year to sort of adjust, remodel, and then make sure that we're still alive a year from now. And so those are the main key points. Now you asked, is regulation necessary? Again, I go back to what I was saying earlier. The question about regulation is what is the goal? The goal here, and I think Kenya and the businesses have all said, is we want to scale. David has used that word, scale. We want to build valuable companies. And in doing so, we want to improve the financial inclusion, right? So if those are the two goals, financial inclusion and sustainable business models, then the regulation is necessary because we need to have that minimum rule book that says what players can do and what players cannot do. We also need to de-risk certain aspects of our businesses. And I brought it up again. We do not want to have business decisions being made by the regulator. We'd rather we make those business decisions because we are the innovators, and we are also using our own capital. So that's my perspective, and that's how I see it. Thanks, Jerry.
Thanks so much, Kevin. Ivan, I wanted to speak to you because you play two roles. Not only are you a director at Dialect, but you're also, a digital lender yourself. So I want to understand from you, what contributions can you make to amending the legislation to make sure that it works for you? What recommendations are you bringing in so that it can be more effective legislation for digital lenders?
And this may sound like a repetition of a few things that both Kevin and David have mentioned, but I'll sort of talk about some of the three most important recommendations that we're making, which is critical for us as one of the larger players. I think the first one is that we cannot apply prudential requirements and regulations to the non-bank digital space. Digital lenders do not take deposits from the public. Instead, they lend off their own investments, typically equity capital or even profits. And so they don't pose a prudential risk to society in the event that they fail, right? And so applying things like, this is your minimum capital adequacy requirement is not reasonable. It is essentially a very heavy hand to a very, I'd say, lighter and more dynamic type of player that we have. One of the second recommendations we're making in line with this proposed amendment is that, we don't see it, we see an actual gap here, is that, yes, we're welcome to be regulated, but we should also ensure that once we are regulated, the non-bank lenders will be entitled to receive and submit data to the credit reference bureaus. Some of you might recall last year as part of the COVID relief efforts, there was a sort of 6-month hiatus given to consumers who are currently borrowing from being listed. Banks were allowed to resume past October, and non-banks like ourselves have been still restricted. So I think that's a second critical recommendation that we're placing. And the reason why is that, as I said earlier, it's not just to negatively list defaulters, but it's to ensure that those who've actually built a great track record of borrowing are not penalized. And the third most important recommendation actually is, an alternative to the proposed licensing, right? And this is essentially, we're making an argument for registration, right? Which is a common practice for digital lenders, or rather digital lending regulations in several jurisdictions like the EU, in countries like Spain or Poland, also even in Australia, right? And this is really also supported by the conclusions of a recent study that was carried out by PwC in Kenya. And the report really showed that licensing in relation to digital lenders is too heavy for the type of activity. Typically, digital lenders are small companies with a maximum of 30 employees. And so therefore, the best solution is for us to use a regulatory system that will fulfill its task and make the legislator feel comfortable with the applied solution, but at the same time will not cause a significant increase in the operating costs of a company, nor will it be complicated or a highly formalized process, right? So effectively, yes, we want to make sure that digital lenders are registered, because today, if you were to ask me how many non-bank digital lenders are there, we can only make guesses. We can look at those that are on the Google Play Store, but also those who are not, right? So that ranges anywhere from 100 to 300, maybe 500 players. I think that they should be registered. And as also David mentioned, in the event that there is a breach of consumer interest, they can be reported and there are consequences attached to it, but you don't need to have a licensing framework to sort of achieve that core, let's call it consumer protection mandate. So those are the three most important recommendations on our side. One, it's no prudential regulations because we don't take deposits. Second, let's ensure that once we are regulated, we can give data and receive data from the credit reference bureaus. And third, let us consider a registration principle instead of a licensing principle.
Okay, very good. David, you were coming in on something?
Yes, I wanted to comment on something that Ivan was talking about, because which is specifically on credit reference bureaus. At the moment, one of the challenges that the central bank has been responding to is that so many people have been negatively listed. And there are two reasons why this happens. One is the methodology of digital lenders. So if you fail to pay, and it's a small loan, typically, you become negatively listed. But the other is the fact that listing on the Credit Reference Bureau, as it currently stands, is a blunt tool. What I mean by that is, if you fail to pay, you get negatively listed. It's either or. Now, in more developed financial markets, you get a credit score. And failing to repay a small loan would affect your credit score, but it wouldn't necessarily stop you getting credit, but the price of the credit that you get might then go up. So the issue is, I think that one of the things that may have to happen in the development of the digital lending industry as a whole is that credit reference bureaus need to switch into credit scoring, possibly more than they are at the moment. And then that would also assist the digital lenders to make more informed decisions and to potentially adapt that into their pricing models. So I think there are some nuances to some of the things that Ivan is saying. Yes, give access, but we need to make sure that we're listing people that really deserve to be listed. Otherwise, we'll end up with people that literally cannot get credit because they fail to pay a 2,000 shilling loan. So I think there's some evolution in the markets to make digital credit more effective.
Thanks, David, for that. On the listing and the credit referencing listing versus scoring issue, you talked about it being applicable to digital lenders, but surely that should be applicable to all lending, banking or otherwise.
Yeah, no, it is.
And then secondly, I wanted to ask Kevin, on that point, is there a need to segregate digital lending from core banking? And if so, should we have two regulators, one for digital and one for core banking as traditionally appreciated?
That's a fantastic question. I think, and this is my opinion, I think that the future of banking is a concept called open banking. The idea is that we aggregate important data sets of the data subjects being the customer. In this case, and Ivan will confirm, is we typically lend to entrepreneurs in the informal sector. So SMEs and the informal sector entrepreneurs. And the challenge they have is they're not getting the relevant products they need to, one, stay in business, two, grow their businesses, and three, save and make return on other, on cash that they've generated, but they may have excess cash for the week, etc., right? The idea of aggregating these data sets is contrary to your question, which is, do we think we should separate? No. I think fintechs like us have one fantastic characteristic, which is the agility, the ability to experiment. If you go through the CBK Act thoroughly, you will realize that the bank is has its hands tied behind its back. Why? Because they take deposits, and because they take deposits, there's a minimum risk threshold that they can take with their loans, with the capital that sits on their balance sheets. And what we can do is, if we're able to work with the fintech, banks working with the fintechs in a way where we can innovate, we can take risks, we can make mistakes, and then at some point the banks plug in as well, then you will see that objective of financial inclusion being met. CGAP did a fantastic open banking working plan. I think they released it last year. And one of the quotes that captured me, or the phrases that captured me, is that it would expand the bank's market, because more people would now be in the formal financial system. Now, do I think we need two regulators? That's up to debate. Different markets have taken different approaches. We have everything from the UK, where they have a financial conduct authority in conjunction with the Bank of England, which then manages, they manage very specific things. In Poland, you have rightly said it, they have an oversight body, and they're working on an ombudsman that will, be in charge of dispute resolution. And then in the UK, they're at the forefront of open banking, and that's why you're starting to see these ideas of neobanks, where you can build lifestyle apps around specific demographics. I spoke about the Boda Boda ecosystem earlier. I spoke about the Mama Mboga ecosystem earlier. Why should they have to access the same service? Why can they get bespoke services? But the only way we're going to be able to build those bespoke services is if we de-link risk, which the banks cannot take, right, and innovation. And so what I'm saying is, let us, the innovators, make the mistakes, experiment, and figure out these new business models. And once we do, let us then come to the banks or work together with the banks to then now make it a mainstream product. So that's the way I would see the future. So,
but Kevin, you're experimenting.
I think that's
Kevin, you're experimenting with the data subjects, and by that I mean our money. You surely that is why we're regulating, because we don't want you guys to play with our money.
And that's what I mean. And it's not your money. It's not your money. It's our money. So we're taking, and we're not experimenting in the way that you think. We are experimenting with new business models. There are a lot of inefficiencies with the current systems in place. If we are able to get rid of some of those challenges, can we offer the Mama Mboga solution straight from the farm, right? So that she's able to track her tomatoes and know that these tomatoes came from Jerry's farm and not David's farm. And if something happens, we're able to securitize it. Those are some of the ideas I'm saying that in the future could be very powerful.
Then let's talk about that, because actually a lot of digital lenders, and Ivan, I'm coming to you specifically, are always talking about financial inclusion, the mamambogas, the helping of the little person, and promoting financial inclusion in the banking sector or in the informal banking sector. But really, it comes down to shark practices, high interest rates, people being required to borrow at a very high rate, not knowing how they're going to repay that money, defaulting on loans, and then Kevin coming to tell us that it's actually not our money. It is our money because we are the ones repaying. Tell us, Ivan, what you're doing about that.
Great. You've lobbed a lot of sub-questions there, but let me try and deconstruct that. So I think you can't separate out the efforts that have been made around financial inclusion. I think there's some really common stats that looks at, if you measure financial inclusion around how many Kenyans had access either to a mobile money account or even to a loan account just 10 years ago, I think Kenya probably has one of the highest levels of financial inclusion around this continent and globally. That being said, I think what you mentioned when you talk about sharp practices around collections, you talk about pricing, has also been some of the, let's call it, some of the less than positive side effects that have also occurred. But one of the biggest mistakes I think I can make is to sort of try accidentally throw out the baby with the bathwater, right? So the question is, how do we address some of these pain points that consumers really feel, right? I'll start with the first one, pricing, which I think is usually one of the first ones that people always look at. Unknown to many people is that ideally some of the very best digital lenders and even some of the banks themselves employ what we call risk-based pricing, meaning not every consumer pays the same rate. Instead, you actually want to start rewarding the consumers that pay their loans over time and successfully end up getting lower and lower rates. And those that maybe have a history of default and whatnot will pay higher rates. And that rate is really commensurate with the risk that they present. So I think that ultimately we can address some of the concerns around pricing by ensuring that every player is putting in place risk-based pricing, right? You want to make sure that people are being rewarded for their behavior. That's the critical one. I think when it comes to collections practices, there have been real breaches. And there, I think there's some actors, I won't say names, and you've probably seen them in the media where they've gone ahead to contact a defaulted borrower's entire contact list saying, Mr. X borrowed from us, can you please tell them to repay? I think that's absolutely unacceptable. And unfortunately, the media does jump on some of these rare exceptions, right? And very easily, the entire fintech sector is painted with the same brush, right? Not every single digital lender is harassing a borrower when they're in default. Not every single digital lender actually has what we call, unacceptable Shylock prices. I'll give you a classic example. A lot of people don't know, but under the sort of risk-based pricing framework, some of the very best customers in Tala are paying rates as low as 5%. That's actually even lower than M-Shwari, right, which is a bank and telco fintech product regulated by the central bank, who charged their customers 7.5% on a 30-day loan. So I think that we can address some of this, call it the dirty bathwater aspects, which you have rightfully called out, but it doesn't mean that we have not also driven financial inclusion. And to Kevin's point, yes, consumers are involved, but ultimately, if we as a digital lender get it wrong, that bill is paid by ourselves, right? Customers are only ever repay a loan if they feel that there's value and there's a relationship they want to preserve. So if you think about Kevin's idea of rapid iteration and failing fast, sometimes great product ideas will just bomb. They will not sort of get that sort of product market fit. And if that happens, it means that Kevin's investors, my investors, have to eat that loss. If it works and consumers like it and they want to access more of it, they will repay it. So ultimately, it is, I think I agree with you that it's primarily our money in the event that things go wrong as lenders, but it's also the consumer's money in the event that the product actually fits with the market and there's a relationship that wants to go on. Because remember, we have almost zero recourse. If someone wants to default on us, short of listing them, and I've heard customers in default get pretty brazen. They'll say, well, I can't pay a loan, you write me up all you want, but I'm not going to pay it back. No, we're happy to take that risk because thankfully the majority of consumers are not like that. I think the majority of consumers actually appreciate what we're providing them. So I hope I've addressed your question, Jerry.
Very well and very skillfully, Ivan. So yeah, congratulations on that. In fact, we promoted Tala in the interim and said that on the best borrowers have a lower interest rate than Mshwari. So I think everyone heard that loud and clear. I want us to know, I want to turn to David and ask him. The question is, if the regulation does come in as it is now and as wide and as broad as it is now, does that mean that Africa as a continent, and Kenya specifically, because we're in Kenya, will now be unattractive to all of these European and foreign investors who have come into the digital lending space simply because it was available, non-regulated, and a free-for-all?
To be quite honest, do you want people as even investors who are investing in a proposition which is a free-for-all? You want to have investors that are looking for a longer term picture. You want investors that are going to have capital that will promote ethical and good behavior. So the quality of investors is an important issue, but to take the shine off the industry a bit so that it's not just about the perception of making tons of money, I think is not necessarily a bad thing. We need to be getting to what's going to be the best business model to move some of these digital lenders so that they take up a much bigger share of the market. Kevin said, what's the share of the non-bank digital lenders? It's a few percent. If we're talking about the market is at the moment, in terms of M-Pesa, KCB M-Pesa, Equity Bank. So the issue of who is investing and why they're investing, I think is important, but really what you want is people who are going to look at the slightly longer term. Yes, they want to make money, but they're prepared to invest in order to grow. And by growing and by providing the customers with what they want, they then get returns. And if some of the Shylocks are pushed out of the market, that's fine by me.
That's a very pragmatic and practical answer. So thank you very much for that. Ivan, I want to ask you a question on how you see the future of this digital banking space being after, when regulation comes in. What do you predict for the next 5 years? What will it look like? Will it look like a very stringent regime? Are you looking to work with the CBK in order to make sure that that there's flexibility in how the regulation is applied? And how will consumers ultimately benefit?
Good question. I think the future is a little dystopian if the bill is enacted as is, and I'll explain why. The first point is, we as the Digital Lenders Association in Kenya have always been open to working with the central bank and also in parliamentarians. In fact, we have had some limited engagement with the central bank in the past. I think that the danger of the bill as it currently stands, especially around prudential regulations, seeking new product approval, is that I see a future in the next 5 years where there's rapid consolidation in the industry, where we potentially go from about, let's say, 300, 400 players to maybe fewer than 20. And depending on where these requirements are set around prudential requirements, the majority of those 20 will actually be bank or telco affiliated, right? So I'm talking about some of the leading banks and telcos that currently have very popular fintech products. And what this means for consumers is it's really a net negative. And that's because if you look at both the financial services industry and even in other markets and other industries, incumbents, those who already have a 95% market share already, are rarely incentivized to innovate as much as it is just sort of protecting margins and profits, right? And so I see a world where in the next 5 years, if this happens and you have 280 fintechs disappearing, right? And everything's consolidated within fewer than 20 players, it means that consumers would potentially face less choice in products, right? Less choice of product providers. And potentially, we might see a scenario where pricing begins to move towards a sort of oligopoly-like situation where the players may all have their arrangements on not upsetting the apple cart. And ultimately, consumers will lose, right? I think what will happen is that there's also the tendency for this to potentially promote backdoor Shylocks, right? So if you have a bill that sort of focuses on digital non-bank providers, I don't see a world where banks and telcos will provide all the funding that all consumers require. And so consumers might be pushed into sort of non-traditional players who've always existed, right? We're talking about the real Shylocks without an app. That is one scenario, right? Where it's a very limited set of formal organized players and maybe an illegal non-bank finance industry mushrooms, where people start trying to seek alternatives.
Thanks, Ivan. And I think that's very clear. What I wanted to ask, and I don't think we've hit on this, we've talked a lot about what the bill is trying to do in terms of regulation and what it's saying in terms of how to regulate the digital industry. But actually, is it addressing the actual pain points of the digital lending industry? Does it touch on exactly what the problems are and how they can be handled, rather than just trying to legislate for broad issues that have already been identified and are already known? So David, I think you can take this question, right?
Yeah, I mean, it's why I keep coming back to financial conduct. And what we don't have, I think, not just in Kenya, but across most of Africa, is that we don't have a strong enough focus on financial conduct. And this is because in fintech as a whole, it's automated, and deliberately so. But it means that the controls that people would actually put in terms of behavior are not there. We rely on proxies. So it means that if we had a better way to focus on financial conduct, then you could have the flexibility that Ivan is talking about, and you could have the protection that the central bank requires without a supervisory model in the old school frame. What you're beginning to see is a need for financial technology as a whole, in fact, regulation, to move from regulating entities towards regulating what those entities do. And this is something which is being experimented with by the Monetary Authority of Singapore. It is something which is being talked about, but we're several years away from this being a concept which is going to be applied maybe across the world. But what we've also seen under, let's say, the Financial Conduct Authority, there's also a licensing or registration process, but there's a lot of flexibility being given to how people operate. But if you misbehave, then you're cut out of the system very quickly. So this is about regulatory philosophies. And at the moment, we're still coming in Kenya from a very traditional supervisory-based regulatory philosophy. We may not be able to change that in the short to medium term, because it may take new structures, it may take new ways of thinking. It will also take experimentation from other regulators before we're potentially prepared to move in this direction. But I do see that will come at some point in time.
Okay, thank you so much, David. Kevin, I want to, before I go to the audience to ask them the questions that they have, and if you do have a question, please do raise your hand, and then I'll point to you. We have some questions already, which I'll deal with first. But Kevin, I wanted to ask you: is there an in the digital space? Is there an over-reliance in Kenya on, first of all, mobile banking? Because most people only have mobile phones and therefore don't use laptops, etc. And if so, what is actually being done about technological information. That means like literacy on technology, as opposed to the heavy reliance on mobile phones, which allows for SIM swapping, or changing phones, all of those things. Surely that's not assisting in the digital regulation space either.
Thank you for that question, Jerry. I'll take the first one about SIM swapping. SIM swapping is fraud, right? So somebody comes, registers Jerry's ID number on a different phone line, downloads one of the apps, and then gets the loan. And then Jerry says, I never took the loan, right? So I want you to empathize with us. So from our perspective, everything told us that Jerry took the loan, right? So it's an asset on our books, right? We are owed that money. From Jerry's perspective, Jerry never took the loan, right? Now, what do we need there? One, we need a way to find out if the fraud actually happened. And then we need to find a way to make sure that if the fraud actually happened, there's a reporting mechanism so that every party feels that some form of justice has happened, so that Jerry is not listed on the CRB for default by the lender, and then the lender feels there's a way that there might be some time they will get that money back from whatever system, etc. So that's what's happening in SIM swapping. And what I can say is that because of the nature of our businesses, a lot of this SIM swapping has reduced because we are working with our suppliers such as Safaricom and other fraud solution providers to manage that risk. And so today, if you try and buy a SIM card, there's a thing called primary phone number, and they will call the primary phone number for confirmation that Jerry is actually buying a new SIM card. And that's what I mean. We can collaborate in this ecosystem instead of always taking these antagonistic positions. And the other reason we suggested this ombudsman is for situations just like this, where we, the lender, are saying, hey, we lent to Jerry. Jerry says it's fraudulent. What do we do? Because even us, as we have to find a way to in our books sort of say this is written off, or this isn't coming back, or it is, so that ombudsman solves that issue for us. You spoke about financial literacy. Financial literacy is something that's core to DLAC's ethos. In fact, Ivan Tala participated in a program called the Money March in March this year, and we ran one last year. And the objective was to educate our consumers on bouncing back and rebuilding better, right? So COVID pandemic hit us, disrupted our business models. And here I'm speaking to the informal sector entrepreneur and the MSME and the SME. And we're telling them, hey, look, all's not lost. This is how you rebuild back, and this is how you build resiliency in the future. And we tried to do a DLAC-wide campaign. It was pretty successful. And we think initiatives like that in the future will only improve the situation. And then you spoke about over-reliance on the mobile phone. I think the mobile phone is what has saved Africa and Kenya in terms of economic recovery. We keep hearing the government speak about economic recovery, informal sector entrepreneurship, SME growth, SME finance gaps, right? The mobile phone has solved that problem. The mobile phone is able to do KYC, right? The mobile phone is able to receive a disbursement. The mobile phone is now a bank branch. The mobile phone is a form, right? So when you look at it that way, you only see opportunity. I only see opportunity. And so I don't think there's an over-reliance. I think actually we have barely scratched the surface on digital financial services. And if we look at the growth of the last 10 years of digital financial services in Kenya, the last 13 years, since 2007, there's no other industry that has had the economic impact. There's no other industry that has had the, bottom impact where it has uplifted a significant portion of the MSME and the informal sector entrepreneur. It has allowed us to have cheaper, loans. I've been lending for 13 years. There was no time we could profitably lend 500 shillings ever, right? Because there's a cost to lending. And lending 500 shillings profitable was such an unfathomable idea. And when people like Tala came in 2014 and launched products where they were lending 1,000 shillings, 500 shillings, and still trying to figure out a profit, that can only be attributed to the fact that the mobile phone is now gotten to that level of penetration that is significant. I think now we're at 70, 80% smartphone penetration. So that's the way I'd look at it. Thanks, Jerry.
Just a final controversial question, which I don't know who will want to take. But if we are going to say that the mobile phone has saved the economy, why is it that the Safaricom and Airtel are the major players in this market? Why is there only a reliance on them as payment providers in this country? And why can't that be deregularized? Who wants to take it?
I think David should take it as well. I think we should all comment because I'm sure
I think everyone should comment and everyone put themselves in the same hot soup.
Yeah.
Okay. First of all, we have to realize that it's not actually, in reality, Safaricom and Airtel, because in the mobile money market, Safaricom is completely dominant. And in fact, its M-Pesa now is a greater contribution to the bottom line of Safaricom now than even phone calls. It's the #1 revenue earner. But to say that M-Pesa or Safaricom or even Airtel, they're the dominant payment providers, well, that's a little bit much, because it depends whether you're talking about volume or value. Value goes through the financial institutions still, and it goes, and of course you've got merchant services. Everybody has a card these days, and that's not Safaricom. And you've got other payment mechanisms. These are all in the National Payments Vision and Strategy. So if we're talking about mobile money, yes, there's effectively an increasing monopoly, and that is Safaricom. And in reality, we're unlikely to change that. If we say we open it up, we've tried in other countries to open it up. In Nigeria, it was said that the mobile network operators could not operate mobile money. There were mobile money providers, and they issued something like 28, I think, licenses, but it really didn't work. And why didn't it work? Because they didn't have the outreach. They didn't have the mechanism to reach customers, which is where the mobile network operators, because they've got your SIM card, they've got the unique mechanisms to reach out. They've got the agency network, which others don't have. Now, in the regulations, there are plenty of rules that suggest that agency can be non-exclusive, and there are rules to promote, if you like, competition. But that really doesn't displace the market dominance of Safaricom. So even if you've put a very positive environment in there for other providers to come in, it's unlikely to make a change in Kenya.
Okay, Kevin. Thank you, David. Kevin?
Well, I think the first point I'd like to make is 85% of transactions are still in cash, right? David has spoken about value versus volume. Value, in terms of majority of value, still moves through the banking system. And so we're still speaking about volume now. And so I will bring it back, not trying to sound like a broken record, but we are at the beginning. We are at the beginning stages of unlocking the value of what mobile money and digital financial services can offer, the economy and us as businesses. So I think I don't know how to say it. I think it's too early to say yes, Safaricom is a dominant player in the sense that they have significant market share. And the way we look at it as a business is we use Safaricom as our infrastructure, right? So, people talk about logistics. Now we have the Lamu port. Guys are saying, okay, now there's an infra. We look at as digital financial services providers, we look at Safaricom as that critical piece of infrastructure that we would not be able to do what we do without them. So they're actually more like our partners. And the way I'd look at it is they came to solve a problem that no one else was solving, right? And because they solved that problem, we've been able to innovate and get to this point. Now, to David's point and to my earlier point, we're still at the beginning. I think, there's a famous book by, what's his name? The founder of PayPal, 0 to 1. We're not yet at 1. We're moving from 0 to 1, right? When we get to 1, we can now start saying, okay, now there's, so-and-so is playing, is the dominant player, but 85% of transactions are still cash. Thanks.
Ivan?
I don't think there's anything else to add. I think Kevin and David really cracked it. I was actually going to say the same points, that it's everyone focuses on the monopoly, a duopoly, but in reality, cash is still king, right? And the second point actually is, I think society will benefit less from dethroning M-Pesa and more from, let's say, an open API world, right? Where if, Tala and other lenders are able to access the same data of a consumer that is held with telcos and banks, I think we can create better products, right? Because I think a world where telcos can still continue to play their important sort of infrastructure role, right? But also more importantly, grant consumers the right to port their data to other providers will ultimately be, I guess, a net benefit for society. So yes, I'm perfectly happy with where the telcos are and their dominance. I just want them to open up their doors and let us in.
Exactly. Yeah.
Cool. Thank you very much, you guys, for answering all of these questions. And I think we've done a great job in illuminating some of the points. I now want us to turn to the questions that the audience have. I'm going to read all of them, and I think some of them will have been answered. And if you think it's been answered, then we can just move on, because obviously they were asked at an earlier point. So let's start with the first one. What are the major issues that you have seen lenders, what are the major issues that you see from lenders and consumers' perspective? Where do you believe regulation can play a role? What other non-regulatory initiatives can be taken to address those issues? Do you think we've answered that? I think we have.
Yeah, unless they have a specific
I think we have.
now.
Yeah, I think we have. Okay, fine. So I think this question goes to Ivan. A question on softer area of regulation, marketing of digital products, and I think you'll be aware of that. The Financial Services Conduct Bill 2018 attempted to, among other things, oversee marketing of digital products. I note that some digital lenders use psychological techniques to market their products. Attached example questions. Beyond just providing correct product information, what do practitioners view as the role of marketing of digital credit products in promoting responsible lending? How could this be reasonably regulated, if at all?
I actually have a problem with this, and that's actually something I should have mentioned. On top of sort of...
you have a problem with what, Ivan, specifically? Marketing?
I'll get the word. I have a problem with the idea that there's a role around the marketing of products, right? Only in as much as there are concerns that lenders are not being truthful, then yes, that should be marketed. If I tell you that my interest is 5%, I do a bait and switch and charge you 15%. Sure, I mean, definitely we should be regulating what is stated in the marketing. But there is marketing has become very sophisticated. It's everything from cookies. It's this idea of, how do I know that there's a potential customer out there for me? Potentially, I want to work with the Googles and Facebooks of the world, where if I see that you are searching for tractor prices and I have an asset finance loan product, I want to make sure I can deliver it to the person that is looking for an asset and has maybe also sort of shown other signals. And because digital marketing has so many techniques, it's almost absurd that we'd have to go and seek approval to do that. So I really do think, and that's why I was saying I have a problem with this, I really do think that unless there are reasonable cases where people think that digital lenders are not being truthful regarding the facts of their products as they market it, this should not be an area where a regulator plays any role whatsoever, right? I think ultimately we want to make sure, just as there's innovation in the product offering, we want to make sure there's innovation in the way in which lenders are able to compete with one another to make sure that they can target and position themselves appropriately with the right consumers. So I hope that answers the question.
I think that's right, and also it promotes competition. It's good to know what's going on in the market, and I think that's important for all consumers. So digital marketing should be encouraged. Next, the question for Kevin. What parameters describe a digital lender? I'm not sure what that means. Is it purely the mode of product delivery, i.e. via mobile, or the nature of credit risk analysis through digital access to third-party data via Google apps that lenders do not necessarily own? So I think the question is really, who is a digital lender? Is it just because you're lending money using digital means, or is it through the credit risk analysis?
That's a fantastic question. So we define it as digital first, meaning that the customer does not have to interact with a human being or a physical location to access the digital financial service, right? And I think it's that simple. I don't overcomplicate it. I think the governor of the central bank at his last MPC briefing was asked this question, and he said, digital is a channel, right? Digital is just a new way of delivering the same old financial services products in a new way. And so we define digital as digital first, where you interact with the product on a digital platform.
Okay, cool. And I think let's have David answer the next one. There are currently, and I think it's from someone I recognize, there are currently 3 amendment bills in circulation targeting digital lenders. Would any of the panelists have any insights as to why Parliament is releasing 3 different bills targeting the sector? Any indication as to which of these bills will proceed?
Firstly, I'm only really looking at one of the bills, so I can't comment on the specifics, but it's perfectly possible for members of Parliament to raise their own bills, and so you're likely to have 2 or 3 bills on an issue. So, for example, on data protection, you had an older bill and then the newer bill, and the newer bill based around GDPR came through. So let me defer to Kevin and Eisen, who will have more on this.
Yeah, go ahead, Kevin. You raised your hand.
Well, so the story is this, right? So we had the late MP of Bonchari, Mr. Oyoka, who had a bill back in 2020. He then passed away. When a member who's proposing a bill passes, the bill technically sort of gets lost in the system. So then the Honorable Gideon Keter then proposed a member's bill. But then something overtook that, where the chair of the National Finance and Planning Committee at the National Assembly stated that in the honor of the Honorable Member Oyoka, they would then have this CBK Amendment Bill 2021. So the bill that is being discussed, and the only bill that really matters, is a CBK Amendment Bill 2021 that was proposed by the National Finance and Planning Committee. Just a sec, Jerry. I wanted to also, I forgot to say something on the previous one around the question of digital lending. Ivan brought it up earlier. The way the bill is drafted seems that they're targeting digital credit providers. And I think that's another, interesting point, because we are very, I would say there are three major types of lenders in the market. You've got the regulated entities, which are the banks, the SACCOs, taking. And then you've got the credit only. So you've seen logbook loans, land title loans, where you get loans in 24 hours. And then you've got us, the digital lenders. And so, this is an important point to note. I don't want to comment on it, but it's an important point to note that it seems like now there will be three lenders, if this bill is passed, where you're regulated either as a bank, SACCO, microfinance bank, or a digital lender, and then there'll be an unregulated section of sort of what we call, everyone else I mentioned.
Okay, thanks, Kevin, for that. And I think, with regards to the bills, it's up to the members of parliament to work together in order for them to amalgamate and come up with the best possible document that will work for us, although they can propose all the different bills that they want. Just to be clear, is DALAC working with the parliamentarians on this? Have you contributed, and are you just making your propositions? Ivan or Kevin?
Sure, I can speak. We have actually, as DLAC, had the opportunity to actually meet with the chair and even members of the Parliamentary Finance Committee. We have also just submitted our own written comments regarding this specific bill, and we've also even met with the Central Bank in the past. So we do have active engagement, as just like any member of the public that is affected by this.
Okay, actually, there's a question. Is there anything specific that DALAC or DLAC, as Ivan is saying, I don't know which one it is doing to negotiate the outcome of the proposed bill? For instance, are we talking to the movers of the bill? So the answer to that is yes. Yeah. Thank you for that, Ivan. Could they address, and this, I mean all the panelists, the issue of on accessing lenders' contacts and calling those contacts in case of default? Is that not misuse of private information? Actually, let's talk about information sharing. Yeah. And I think, David, you've touched on this a bit. You've talked about data sharing in the context of credit scoring or credit listing. And you're talking about sharing of information between banks and the core banking as well as digital lenders. Where is the line between the credit access for credit listing and scoring purposes and a breach of data privacy? Can you touch on that?
Yeah, I mean, one of the challenges that you've got with the digital lending methodology is that because we're talking about using a mobile phone, when you sign up to the app, typically you give permission for various forms of data access. And what this means is that it enables the digital lenders to access your address book. And you've given them permissions that you may not realize that you've given. So this is an issue which is commonly called informed consent. And so you've given permissions, but you don't realize. And people, as in the digital lenders, even those that are not behaving ethically, will say, well, look, this person has signed up for this and they agreed to this long list of terms and conditions. It's the same as if you sign up for any Microsoft Office product or software. There'll be a whole pages and 25 pages of terms and conditions, which you don't read. And this is one of the core challenges, if I can put it that way, because even when you talk about privacy, under the shield of this person has given permission to access this data, what then does privacy mean? So it then tracks back to informed consent. It also becomes slightly challenging. We do have data protection rules and regulations now. But again, if someone has consented to you using their data, I'm not even entirely sure, without detailed reading of the Data Protection Act, whether the Data Protection Act would protect you. When it comes to sharing data, it depends on data sets to some extent, because if you're talking about sharing data sets, then typically the data sets would be anonymized. So you wouldn't be able to tell that this is relating to a particular person or individual. When it comes to something like data on a particular individual, let's say at a credit reference bureau, and they have a credit score, typically what you would access is the credit score and not the underlying data that gives you that credit score. So again, there are protections built into the mechanisms. So the answer, I'm afraid, is it depends, and whether that's adequate or not is another issue. A lot of it comes down, I suspect, to this issue of informed consent, which I don't think is given enough coverage. And again, this is a financial conduct issue.
Ivan, could you comment specifically on this? Do the terms and conditions, or should the terms and conditions include consent to access contacts of those people in your phone book in case of default?
So I can answer that legally and then ethically. So legally speaking, if you're a lender that wishes to do that, because perhaps let's say in China, that's the norm, right? Yes, if you sort of have this informed consent, like you're informing the consumer about what will happen in the event of default, that you'd have the right to go ahead and sort of access their phone book, and the consumer is aware, then legally speaking, yes, you could say you're covered. But ethically, and I think as per cultural norms in this country, I think that's fully unacceptable, right? It's just, we're not sort of just living in one little village, taking loans from our villager, across the road, right? There should be privacy and respect, right? And I think that, as David mentioned, unfortunately, many of us are not really good at the small print, right? And when we are seeking credit, it's almost like when I see those sort of cigarette advertisements with smoking kills, even when it's in big bold font, we're not very good at processing information ahead of going ahead to and execute a transaction. So I think that yes, legally you could say that I told my consumers before they borrowed from me and they were aware, and maybe they even clicked a button saying literally, yes, I agree, you can use data and contact my contacts. The real question is, should they, right? Is that a cultural norm? Is that acceptable? And now I'd say no. We, examples how obviously don't do that. We do actually have a customer data agreement on our website that's accessible, where customers can actually read through it, even ahead of going into the whole borrowing transaction phase. But over and above that, we also are cognizant of what is acceptable behavior within society that we operate in.
And I think, again, it comes down to financial literacy, because a lot of people do not read the fine print before they sign on to the loan or the digital borrowing. And there's another question here. When someone signs up to digital credit, they agree to a set of conditions that they have usually not read. So I think, the point being that you're supposed to read the terms and conditions prior to accepting the loan or any borrowing whatsoever, so that you're sure of what the terms and conditions are. Which includes, and the question says, which includes access to address books, etc. So one issue is informed consent. Whether this conforms to the Data Protection Act is tricky, because on paper, at least, consent to access to data has been given. And I think that's exactly what we're talking about. We're saying that if you have given your consent and accepted the terms and conditions, and you accept the terms on which your loan is being borrowed against, and therefore whatever consequences fall out from there. Ivan has correctly pointed out that there is an ethical issue on that. I don't know whether, Kevin, you want to add anything to that?
Well, I think to add on to what Ivan has said is, what are we doing as DLAC to try and sort of push the ethical argument? So DLAC has a very strict code of conduct, and in fact, several players that use this debt shaming practice for collection have tried to join and have actually been rejected in some instances. In other instances, there's been there's a negotiation where for them to join, they must stop the unethical practice. And we're hoping that those negotiations will be successful. I think another initiative that could solve this is, and I see Jared Gutanga is on the call, CIS has a code of conduct that they have been trying to get approved by the CBK, and have gotten several ecosystem players, so not just digital lenders, but other lenders, including the banks who use the credit reference ecosystem. And this code of conduct, again, is very clear around what kinds of data, what kinds of debt collection practices can be used. And I think that these two codes of conducts can be very powerful tools in the future to mitigate this practice. Because I loved what Ivan said. There's a legal and an ethical, and I think we're all in agreement that it is unethical, right? So now, how do we ensure we manage that? And David has said conduct. How do we regulate conduct? So that would be my.
Thank you. And I'm asking if there's any digital protection, or someone who knows a lot about data protection, not digital protection, lawyers who are available to comment on this, then we would be welcome, because I know that there's a difference between the storage of information, gathering of information, and what you're allowed to do, even with that consent being given. So I think it's important for any digital lenders to be aware of that and adhere to that, because obviously there are consequences for breach of the Data Protection Act. So let's go to the next question. A more specific question on marketing to Ivan. There are a number of regulators that have insisted on responsible lending. The US, the UK, Australia, Nigeria, only in statute though. And all the laws that loosely describe require the lender to perform checks before lending to prevent people from accessing credit that they can't afford. While this is too broad to be reasonable, is there any compromise that can be reached between competition among lenders and responsible lending conduct? Apologies for the long question. Now, from what I can see, there are two parts to the question. Number one is on the marketing, and number two is on whether or not you should perform checks before accessing or allowing a certain type of lender to borrow. And does that also mean that you're restricting the market to which you market? Can you only market a certain product to certain people who are able to access that market, Ivan?
Yeah, actually, I read this too as one, right? This idea that does responsible lending extend to the way in which we market even ahead of actually going ahead and providing the funds? I would actually say that perhaps marketing might be tricky, right? Because in many ways, there's only so much data we have on those who are viewing our ads to even determine whether or not they should be viewing it. But when it comes to credit underwriting, right, which is really determining, can this borrower afford to take the credit? It kind of goes back to a point that I raised, which is if we as non-bank lenders and all lenders have to report information to credit reference bureaus and we can access this, then I think there is absolutely a requirement for a lender to essentially do an assessment of, can this person who's clicked on my ad and has applied for a loan really afford an additional 5,000, given that they probably have 50,000 outstanding amongst these 4 other lenders? So, if non-bank lenders are quote unquote flying blind, right? We don't have access and ability to contribute to what the banks can see, then it's not a level playing field, right? We could actually potentially be in a situation where we are making the problem worse, right? Because maybe they are 10, 15 bank fintechs and 200, 300 non-bank fintechs, and we're all lending to the same consumers, right? So I might think to myself, based on the information that I can see about this consumer, they can afford it. I am being responsible, I'm telling them the terms, but unless I have full visibility, both from my non-banks and banks, I don't really know what danger my product will present to this customer's financial health. So I'd actually say that, to answer your question, I don't think marketing, I don't think responsible lending can start a marketing unless it's about making sure that there's truth and clarity in the data that we are presenting to a consumer. But I think before money is dispersed, when we underwrite, there we can be responsible lenders.
I think also there's that idea of being aspirational in a very capitalist way, where if you know that if your credit rating is better, then you'll be able to access a lower interest rate, then you can work towards that. And that's the essence of everything, really knowing what you have to do in order to improve your either credit score or access certain funds, correct? And I think marketing, opening that marketing and being transparent is better than just curtailing it. The next question, my apologies for dragging us back to the question about the bill. Ivan, are you at the discretion to share your specific submissions, not just the random specific submissions to the parliamentary committee? Is that something that DLAC will publish?
So yeah, I think we'll do so, but what I'd say is that we want to wait until after the deadline. The deadline is actually this Friday, and I think we can look at putting the same on our website so it's publicly accessible.
Have you also
and as chair, we'll put it on my LinkedIn as well.
Great. Have you also allowed for public submissions through you, or do people have to do their own submissions if they're going to meet the Friday deadline? Can people make their own suggestions through DLAC?
I think, unfortunately, because we've actually already finalized our submission, it might be more useful people go directly straight through the Parliament.
Okay. Another question on consent. Is uninformed consent really consent? Uninformed consent is not informed consent, and therefore is not consent, if that makes sense. Transparency of the information communicated has been mandated for consent, so giving consent without knowing isn't a thing. I hope you guys understand the question. Should I read it again?
No, I wouldn't mind taking that.
Go ahead.
It's a very interesting question, and I'm reminded of a it's a very interesting question, and I'm reminded of I think in the South African, I forget in which law it is in, but it's, and David, you can help me here because we have discussed it. If you give a loan to a customer in a language that they do not understand, and the customer is able to prove that they were not presented the data in a language that they understand, even if we, the lenders, disbursed money to them, that loan is deemed, that contract is deemed null and void.
It's in the National Credit Act.
The National Credit Act, yes, in South Africa. So to that audience member's question, is uninformed consent really consent? It isn't. And you can see other jurisdictions trying to solve that in innovative ways.
Okay.
I think if I can just come in here, because
David,
the challenge you've got is in digital methodologies, when is informed consent? In the National Credit Act in South Africa, somebody has to sit down and somebody has to explain to you in your own language. There's a literal requirement for that and for that methodology. In digital credit, clicking a box is supposed to signify that you've read the terms and conditions. Yeah. So this is where actually creating the process by which consent is informed is important. It may be that the central bank may require you to call the potential borrower, but if you do that, then some of the benefits of automation and the lower costs begin to get lost. So this then falls down on financial literacy etc., etc., etc. So there are a number of ways in which you can move towards informed consent. But this issue of when is informed consent will always dog this particular industry. And to come back to the question that Ivan was answering, which is on effectively whether people have enough money to repay their loan. This again depends on whether we're talking about nano credit, the smaller loans to some extent, or whether we're talking about, shall we say, larger loans, enterprise level lending, where you would expect a level of due diligence to be gone through to assess whether someone has the ability to repay that loan, the typical Biashara style lending that's popular with the banks. And assessing whether someone can repay that loan goes way beyond a credit score. But in pure digital lending, it then means that we have to have access to data, and we have to have access to good data sets. Well, in pure digital lending, that would then require open banking and open API and APIs, etc., 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 and also good quality data sets. And if you talk to people at the credit reference bureaus, one of the reasons that they hold back on sometimes from giving credit scores is because their data sets are not good, even if they're attached to some of the good data sources. They can't always place reliance upon the quality of data.
Okay, thank you so much for that, David and Ivan. Jared Gendeka, I'm probably butchering the name, has just commented just to confirm that the CBK has recently approved the code of conduct that will govern credit information sharing. So just to clarify on that point. Okay, question for Kevin. Please confirm whether either the CIS and the DLAC code of conduct have been approved by the CBK. It was a requirement for approval prior to submission of credit data by digital lenders to credit reference bureaus. Kevin?
Yes, so Mr. Jared Gitanga is the CEO of the CIS Kenya, one of the very important stakeholders in lending and just the financial ecosystem here in Kenya. And so his confirmation is a very positive thing. I think most of us who are digital lenders on the call must, that's given us some excitement. It means there's some light at the end of the tunnel. The question is, the person who asked the question is right. One of the conditions for us to be allowed to submit and pull data from the Credit Reference Bureau was this code of conduct being approved. And so we're hoping that this is a sign that we will soon be allowed back into the ecosystem. So thank you, Jared, for confirming that for us. We're very excited. And I think the question is answered.
Well, what does it actually mean, aside from being able to participate? What does that code of conduct mean for digital lenders and for consumers?
Well, it means that we have to abide by a minimum set of rules and conditions in terms of, and more from an ethical point of view, from a conduct point of view, where we are not using the credit bureau to harm our consumers. The central bank has been quite clear, and I think David brought this up earlier, where their issue is they do not want to have financial exclusivity, right? The question was, is listing a young person who's 23 years old on the CRB for default of 300-400 shillings or amounts of below 2,000 shillings, strategic for the future of that person? And is it strategic for the financial system? And David alluded to the fact that we need to start focusing on credit scores rather than that actual credit from the consumer perspective. So what it means for us, what the code of conduct means for us is that we now have to ensure that we are not harming our consumers by listing them on the credit bureau. So there'll be a minimum set of standards, and one of which will be not debt shaming.
But what I mean by that is it's only applicable to the members of DLAC. Not all digital lenders are members of DLAC. So it's just your members.
No, CIS is a much larger stakeholder in the sense that they have more than digital lenders in their ecosystem. So they've got the SACCOs, they've got the microfinance banks, they've got us, the digital lenders, they've got DLAC digital members, they've got non-DLAC digital members. And so what that means is that this code of conduct is sort of wider than the DLAC code of conduct.
But still not mandatory to be a participant in. Good to have, but not a
No, it will be mandatory to, if you will not be allowed, it is likely that you will not be allowed to access the CRB ecosystem as an unregulated lender, right, without signing the code of conduct. And that's why CIS, and that's why that news is such good news, because we've been waiting from that approval from CBK, and Jared has now confirmed it.
Got it. So both the consumer and the lender are incentivized with the CRB requirement. And understood. Thank you for that. Okay, next question for Ivan, I guess. I just looked at the terms and conditions on the TALA website, and it says that by downloading TALA, I hereby give consent to the collection and processing of my personal information for legitimate business purposes, included but not limited to determining my credit score and providing a loan. Now it says I give consent to personal information for legitimate purposes, included but not limited to determining my credit score and providing a loan. Can we consider it as an informed consent?
Well, in the event that, as this Nitin has gone ahead to read it, which is, we encourage such behavior, I would say it is informed consent. I mean, I think by the time one has gone through and read it, absolutely. And I think they've highlighted not limited to 10-point credit score. Well, that's actually because we also would utilize that information to help us target similar borrowers like yourself, right? Because we don't just rely on the Credit Reference Bureau, and historically digital lenders like TALA have been able to utilize thousands of data points. I mean, I'll give you an example about something that we use to determine creditworthiness. We'll look at your phone book or your contact list in your phone book, and we've found that borrowers that say both first name and last name of contacts are actually typically correlated with a higher propensity to repay their loans. Sounds strange, right? This idea that, well, because you say first and last name in your phone book, when we look at those who have repaid our loans, we've actually seen that that is actually a useful piece of information. Because there's so many things that we will look at, right? To look at all the data on your device. That will also help us determine, is there something about people who save their contacts like this that we can use when we're doing targeted marketing? So yes, to whatever extent that you are able to read through and get through to the end, it is absolutely informed consent. But I would say that it should not necessarily be a red flag that the data we utilize would be including but not limited to determining your credit score and providing a loan. It's essentially yeah.
I think for Nitin, it's good that he's understood that the concept of but not limited means that it's wider than just the information that they have. And I think that's important for all consumers to know. Let's go to, sorry, David, go ahead.
Hi, Nitin, long time. You asked me to respond to this, that's why I'm responding. One of the issues that we've had historically is the algorithms, the decision-making for digital credit has relied upon poor quality data sets. And so as much as TALA and others and Branch and others will say we consult 5,000 data points or whatever, yes, they may well do. But what's the critical data point they've been using is how well have you repaid your previous loans? There's a heavy weighting in the decision to how you've performed. That's why the amounts you get are very small and they gradually increase. It's because the digital lenders want to take you through that cycles for you to prove your credit worthiness. So in a sense, we're not yet at the point where pure algorithms around your personal data are good enough yet to determine how much credit you can receive. Otherwise, we'd be giving different loans and et cetera, et cetera. So this whole point about credit worthiness, we're not yet there in terms of data quality and the algorithms, but we're moving in that direction. And it does take time to accumulate the data, and it does take time to perfect the algorithms. So I think that's also relevant.
I think there are 2 points there on credit worthiness, A, and then B, on credit default and how digital lenders then react to that, and they're not limited to being, what can I do to get my money back? I'm looking at the time, and I know that there's 9 minutes left, so I just want us to be very quick on the next set of questions. The next question: I appreciate the low quality of our credit rating bureaus. Are there, however, alternative methods of credit rating that are being considered by fintechs or just the financial services system at large, or will the sector simply be crippled by the lack of quality perpetually? Who wants to take that question?
Well, maybe I can just come back to saying it's the quality of the data. Okay. And it's the data sets that you're using and the decision making you're making on the algorithms, because that's the way that you would take the lending decisions. And because we don't have pure access to data on one side, and we don't necessarily have quality data, and also because this might be new data, we haven't incorporated it into our algorithms, and we don't know the weightings to give. So it's going to take time to move to a situation where there's less reliance upon the CRBs.
Yeah. Jared Gendeka is just confirming and clarifying that minimum standards include effective dispute resolution framework. Fortunately, CIS Kenya has now secured the approval of the company's registry of registration of Tatua Center. I'm not sure, Kevin, if you can put context to that. And he's confirming that it is mandatory to sign up to the COC. I'm not sure if you can put context to the registration of the Tatua Center, what impact that will have.
So some other piece of good news that I did not know, but Tatua Center was an initiative by CIS Kenya and CBK for a dispute resolution in matters credit. And so what that means is that I think what Jared is trying to imply is that they are now in the process of creating this dispute resolution center and expand its scope, right? And then COC is code of conduct, and what he's doing is that he's confirming that it would be mandatory to sign that code of conduct to access.
For digital lenders, excellent.
Not just digital lenders, anyone in the credit information framework, any lender.
I see. Yes. Okay. Thank you very much for that. Someone else is asking, should it be mandatory for digital lenders to also submit positive credit ratings, not just negative only? And I don't know who wants to take that. David is smiling, so I'm going to point to David. David?
Sorry, my electricity just flipped, so I missed some of that. Can you just repeat?
No worries. The question is, should it be mandatory for there to be positive credit rating, not just negative rating?
Okay, I mean, it is in negative rating. Positive rating means effectively sharing your data sets with the Credit Reference Bureau so that they can determine that whether someone is of good standing. We are moving increasingly towards positive rating. And when you think about developing credit scores, you would need that information to develop credit scores. Otherwise, how could you reliably determine that credit score? So I think as the industry evolves, we will absolutely move towards positive rating. We'll have to. And then we'll be able to apply differentiated pricing as a risk-based pricing, as Ivan was talking about, as a mechanism for allowing people access to credit, but also accounting for the risk of that loan. So yes, it will happen.
Okay. I wanted to know, we have 10 more questions to go and 5 minutes. Are we able to extend, or should we just try and get through them as fast as possible? One word answers if possible.
I'm okay.
Okay. Ivan, Kevin?
Unfortunately, I do have a hard stop on the hour. It'd be great if we could try maybe.
Okay, let's try our best to get through them. I would like to know what methods of credit recovery DLAC proposes its members, given the traditional debt shaming method is currently outdated and shunned. I ask this because for a digital lender, like most enterprises, cash flow is key for survival and survival amidst competition. So basically, is there an alternative to the normal methods of credit recovery, including debt shaming?
I could probably take that. You know, it's been quite challenging for a lot of lenders, and they've had to rely on a completely different approach. For example, we as Tyler have had to utilize a relationship-based approach. That is, you want to incentivize the customer to maintain and continue the relationship. And in so doing, it only becomes natural that they should actually go ahead and repay that loan. But what I'd actually say is that the first line of defense when it comes to debt collection is in who you choose to lend to in the first place. And what's actually now typically happened is that many lenders have resorted to tightening acceptance criteria and lending to those customers, either who have proven themselves, so maybe only lending to repeat customers as opposed to new customers, or really make it very, very difficult to sort of enter the funnel. Because essentially those are really the only customers who you could successfully use this tactic of saying a relationship-based approach. Otherwise, if there's no recourse, and there's no consequence to default, we're at the mercy of our defaulters.
Yeah. Yeah. Thank you for that. Where do loan and equity crowdfunding platforms fall in the regulatory space, given the broad definition of digital credit? Do they fall into the space, and where do they fall into it? One word answers if possible. Kevin?
Sorry, what was the question?
The question is, where do digital crowdfunding platforms fall into the digital lending space?
I think David would be better placed to answer that because he's done quite a bit of research on crowdfunding and regulation.
Okay, so equity-based crowdfunding is different from P2P crowdfunding, peer-to-peer crowdfunding. So they're two different questions. If it's equity-based crowdfunding, then capital markets has to get involved, and there has to be a different way of dealing with the issues the capital markets are involved in. And I think that's a separate discussion. If you're talking about lending, I think that this begins to touch upon where you're talking about the size of the loan and the level of personal risk as it evolves. So I think if you're talking about crowdfunding for SMEs, there may be other issues in addition to the issues that are being raised under in this forum. Now, whether crowdfunding platforms should have their own variant of this regulation, well, currently crowdfunding platforms are not regulated, but in Kenya. But we've now got Possession, who has a license from the Markets Authority. So they've got a license to operate. So my guess is that that'll this issue will play out over time. I don't have specific guidance on whether crowdfunding, unfortunately. I think internet's been unstable.
No worries. I think we heard what you said, David. Thank you so much. Ivan, I'm just wondering if you can indulge us for another 5 minutes, or whether I should thank you and allow you to leave.
I can do another 5 minutes. I'll just.
Thank you so much. I think some of these questions are so interesting, and I think it's worth just going through them, because this is information that we'll never get again in this kind of platform. The next question is, what role will open data APIs play for digital lenders when it comes to product innovation? I don't know who wants to take that.
I could
Kevin?
take that. Yeah.
Okay, go ahead. Go ahead, Ivan. Yeah, Ivan, go ahead.
Sure. Open APIs for me are everything, right? I think a world in which, let me take a step back. Why does, I'm sure in KCB M-Pesa, Feliza potentially have the dominance they have, right? If you think of non-bank digital lenders having 5% market share, maybe those three names alone control the other 90 or 85%, right? Those are the three big boys, so to speak. I would say it's because they have access to highly valuable information. If I have access to all the inflows and outflows into your M-Pesa wallet, your current standing, I'm able to design and better products. I'm able to have robust underwriting systems. And everyone else, like ourselves, has to sort of, as Kevin said, spend years creating these algorithms that can ideally become profitable. When these three players are sitting on the most valuable information, but that information doesn't belong to them. It actually belongs to the consumer. So in an open API environment where you have, they're mandated to share that information with third-party providers on the request of the consumer, it begins to chip away and erode that advantage. So I would actually say that open APIs could potentially be the game changer, right? In terms of what happens when all lenders have access to the same information. What happens to product quality? What happens to competition? I think that would be really interesting. So that'll be my response to that. Thanks.
Okay, thank you. What will the agility and revenue profit impact to digital lenders on complying with regulations as it stands be? Anyone, Kevin?
Well, I spoke about this earlier when I said, prudential guidelines will increase our cost of capital, because it technically means we have to place private capital, not depositors' money, in a non-interest, a non-return generating deposit. So that doesn't work for us. That means that our cost moves up. There shall be compliance costs in terms of having to comply with this new regulation. Again, that cost will have to be pushed down. I think the main worry for all of us is the business decisions, such as approval of products. Depending on how long those take to be approved, there will be a cost there. There will be an opportunity cost there, and that obviously will affect us. In terms of licensing vis-a-vis registration, what Ivan talked about, again, there'll be a cost there. If we need to get licensed, how long will that license take to be issued? So how do we then deploy the different stages of capital? And that, of course, will have a cost implication and a return implication for the investor. So I hope that answers that question.
Okay, cool. How do digital lenders ensure data privacy of their consumers? Many of these apps have access to critical consumer data, such as messaging and contact permissions. So I think, Ivan, you're best placed to answer this. Although you're saying that you've got the consent of the consumer to access this information, how do you then manage that information so that it's kept private?
Okay, sorry, would you mind reading that out? I was actually trying to read through it. This is the Q&A portion of this.
Hold on a minute. How do digital lenders ensure data privacy of their consumers? Yeah, many of these apps have access to critical consumer data such as messaging and contact permissions. So the point being that although you may have consent, how do you manage the information once you have it?
Okay, this might be out of my depth. I wish I had our IT manager here. But what I do know is that from a system perspective, there are limits and levels of accessibility, visibility within the system. So in fact, almost no human eye needs to see this data because, well, the algorithms are able to sort of process it. And only in the event that there is maybe some sort of error that's arising would you have select individuals in these specific teams going into that database to essentially look through it. So ultimately, it's just really about information security control. This is not information that any staff member, right? Why should I take my example? Why should I, as the leader of the business, be able to find out what a consumer put in the application? I don't need that information at all. I don't need to actually have any one single individual's piece of information.
I think it's about storing of the data and what happens to it and how long you can store it. But I think what you're trying to say is that you do everything in accordance with the Data Protection Act. Correct.
And yeah, and storage, of course, local servers, et cetera, yeah.
Okay. Hi, this is this next question. Hi, this is Julian, co-founder of BFREE, an ethical credit collection manager from Nigeria, currently expanding in Kenya. In Nigeria, we work with companies like Branch, Carbon, Fair Money, etc. to make their collections more efficient, scalable, and user-friendly. There have been several cases of third-party collection agencies breaking the value chain of ethical lending. Question: can we ensure ethical behavior across the whole lending value chain, including third parties? Kevin?
And this is what we were talking about with the codes of conduct, right? The reason CIS Kenya was given, the reason they developed that code of conduct is because they got a directive through a circular in April 2020. I think it was April 7th, basically defining the criteria to access the Credit Reference Bureau, right? And those codes of conduct is making it mandatory to abide to those codes of conduct is what will have that effect. So we are yet to see the effect in Kenya, but we're quite confident now that it has been approved, and we can now track to see what the results of that will be. I'd be expecting positive results.
Okay. Thank you. Could either of the associations come up with a self-assessment questionnaire for digital lenders to review and complete on an annual basis to ensure good consumer protection practices, i.e. on handling of data, redress of complaints, transparency of product information? So basically the Mary is advocating for a questionnaire that people could answer to make sure that they're in compliance, just a good conduct guide, kind of.
I think Mary has brought up a fantastic idea, and I think it's timely. We've just operationalized the Office of the Data Commissioner. We are now discussing the fact that the Code of Conduct by CIS has now been approved. We are also discussing CBK Amendment Bill 2021, which will intend to regulate us. Therefore, there will be guidelines on what that questionnaire should look like into the future. And so definitely a very good idea that DLAC will pursue to develop once we can.
Okay, thank you. Does LIPA later qualify as a digital lender? I don't know if anyone has heard of LIPA later.
Yes, they would, because we have a lot of, so LIPA later is buy now, pay later. So you go into a shop, you see a nice sofa set, and you access the product at the POS. So it's called POS lending. So when I was saying earlier, what is digital lending? Digital first. So yes, the customer is buying a physical asset, right? But they're interacting with their lender at the POS. So at the POS, instead of pulling out cash or their credit card or their debit card, they'll have a form, there'll be an interface that's digital that they'll interface with. It will then do scoring and then give back a result, and then they will be able to take the product on credit. So yes, the answer is yes. And we have buy now, pay later members in DLAC. One of the largest actually in the market, Aspira, and in fact, one of the board members of DLAC.
Oh, excellent. That's very good to know. Last question, is it allowed to an arbitrary talk to the signee when you received a loan, and then while you fail to pay, the bank discuss your personal matters to the person who signed to know the status of whether you will pay or not? It must be private. So this is a question on privacy, and if I'm understanding correctly, are you allowed to talk to the I guess the borrower when they receive the loan, and then discuss their failure to repay with a bank on their personal circumstances, and to know whether they will pay or not? But I think perhaps there are two different things. There's taking a loan digitally and taking a loan via a bank. And the digital lender will not be able to speak to a bank on that currently, and the information is not shared, correct, Ivan?
Yes, that is correct. That should not occur. I think if you apply through one channel, it's highly unusual that a digital lender would then go to a bank and say, well, this customer not paid a loan, unless of course you're borrowing from the bank fintech, and then it's really a sister organization. So if you borrow from Mshwari and then you try to approach NCBA for a car loan, it's one profile, right? There'll be
information is shared, yeah, because it's a bank and the fintech, but digital banking for now.
Exactly. Yeah.
Okay, so I think we've come to the end, 15 minutes later, but nevertheless, we have covered a lot of ground in this discussion. It has been an excellent discussion, very eye-opening for everyone, and especially for all of those who listened. I saw that at the height of the listenership, we're about 105 people, so that's great. Everyone who participated, we thank you, and we want to say that you guys did a great job, Ivan, David, and Kevin, in illuminating these points. You were so fantastic and so knowledgeable about your subject area. So that was very, very important for us. I want us to just leave with a word of the day. And let me give it to Ivan first, because Ivan is in a rush. Ivan?
Yeah, thank you very much, Jerry, and everyone else who joined us. I think really the word of the day is, I'm going to paraphrase what David said. It's the time for regulation is now, right? It's inevitable. But how we go about doing this could mean either continuing Kenya's amazing legacy as the home of fintech innovation, or bring an end to it. I hate to say this, but banks are rarely the forefront of any innovation. And the more you try and make non-banks into banks, ultimately, I think it'll be a very heavy price to pay while seeking consumer protection. So in favor of regulation, but let's do it wisely, let's do it correctly. Thank you.
Thanks, Ivan. David?
Yeah, so I don't have that much more to add. I think it's been a great exchange, but we have to say that regulators are going to come into this sector, and I think it's time for the sector to be regulated in order for it to grow. I disagree slightly with Ivan on whether banks can be innovative. But I do think it's only a small number of banks that are truly innovative. You've seen what Equity have been able to do with Equitel. So I think that disproves Ivan to a certain extent. But I do think it's important to preserve the ability of financial technology more generally to innovate. So you have to regulate at the right time and in the right way. And what we're actually arguing about at the moment, or discussing, is, are we doing it in the right way? Are we going to preserve that flexibility within the fintech space, or in this case, the digital lending space. And if we can do that, then I think we should move ahead. The challenge that we've got is most of the issues raised are actually raised around financial conduct. And that, to me, for the future of financial technology in Kenya, will require a much broader approach to financial conduct than we're getting in this particular application to the central bank. So there's a bigger picture issue in where areas like informed consent can be taken up, and. So there's a whole bigger picture which will need to be addressed.
Thank you so much, David. Kevin, last word of the day.
My word of the day is potential. And then I would couple it with innovation. I think the regulators, the parliamentarians, and anyone who has input into the CBK Amendment Bill 2021 should be focusing on what the potential of digital financial services could mean for businesses, customer, and I'm a Kenyan, so country. And in that regard, you know, I loved what Ivan said. He talked about open APIs. Open APIs will not only make the banks, it will not only make the banks, you know, issue or give us access to more data, but they will also get access to more types of fees, more types of revenue lines that will make them and their businesses resilient. And so my word of the day is potential. Let us think of what we could be in 10 years if we do this right.
Excellent. And I think this has been very important for us just to learn a lot more about what's going on in this space, understand regulation, and it's been an eye-opener for me as well. So thank you for allowing me to moderate. I want to say thank you to DLAC for hosting. Thank you to all of the participants who asked questions and were engaging. You guys were great. Everyone have a very good day and see you next time.
Thank you.
Thank you. Have a good day, everyone.